Composite down by more than 0.5%. Shenzhen also dipping lower, some 0.4%. Hong Kong's Hang Seng there, 1.2% in the red. Let's bring in Kian Soon, now CEO and fund manager, Astral Asset Management, for more on these latest figures. Kian Soon, let's talk about China's latest home prices, more than 3% down. Let's talk about what the economic repercussions are, seeing as how property is a key pillar of the economy.
That's correct. As you mentioned, it's a key pillar, and the declining prices from June and now July at a bigger extent will definitely spook the markets. It's also that there are many dismay economic data coming out of China that has worries investors from declining consumer prices, slowing growth of exports, imports, as well as now we see that happening in the property prices.
So, as we talked about, of course, you also mentioned the quite dismal retail sales figures, industrial output. Would this pressure, and combined with the latest property figures, property prices just came out, would this pressure, the PBOC to introduce more stimulus more quickly?
We have seen that yesterday there was an announcement to cut interest rates, and this is the second time they are cutting it. I think there is also room for them to, look at the reserve requirement ratios, which they have room to make adjustments. But so far, I think the central banks as well as the Chinese government has been implementing the stimulus at a very slow pace. Probably they are adopting a wait and see attitude because there's a whole list of bad news that is coming out into the markets, and probably they are taking their time to basically scale up the quantum of stimulus package. But for the market, it has been very disappointing, as you could see the market's underperformance due to disappointments of the lack of strong stimulus packages.
And so how long do you expect this volatility to last, and what's in it for investors then?
I think this has been going on a while for 2023. Since the COVID recovery, where we see a big bang for the stock markets in January, there have been ongoing concerns with the US-China tensions. There are concerns about the slowing recovery, and you could see investors running for the door out of China. And when you recently hear that there are stimulus packages, going to be announced, all the investors started to be interested and start to rush into China again. So you could see the in and out, and the investors are panicky. Their investors are taking their time and hoping that a big stimulus could help the economy to overcome its current challenges.
Well, U.S. markets also rattled, as we saw overnight. That's by Fitch's warning that it may downgrade, some top banking names. What is the likely impact of that on markets? How long could it last?
I think for the downgrade of the Wall Street stocks, bank stocks, is really an assessment of how extensive the downgrade will be. For the time being, I think the market is closely watching, and see what is the extent of the downgrade before coming to a conclusion. But the banks did have a good run this year given the rising interest rate environment. If you're a consumer bank and your net interest income is strong, they actually have a good run. I think the concern now is what about the lenders that potentially has lent a huge amount of money to commercial estate in the United States. As we know that the commercial real estate in the US is actually facing a huge decline in terms of valuations, and there could be back loans requirements going forward.
Yeah, so we talked about the banks having a good run so far this year, but the possibility that this good run could come to an end because we're seeing the Fed sort of signal that it's likely to hold in September. It hasn't said anything about rate cuts. But with those, could it put an end to the good times for banks?
That's the interesting phenomenon that has been happening when there's good news in the market. For instance, yesterday evening, it was announced that the retail numbers were good. Then the market actually starts to get panicky because potentially the Fed could have more room to raise interest rates or to keep interest rate at current levels so that they could tame inflation because there's no risk of economic slowdown. But at the end of the day, what I think is going, the train finally is going to hit the wall. There's going to be a economic slowdown coming in next year. And for the United States, it's going to come later rather than sooner, but it's going to happen. And when that happens, it's going to hit the various sectors that are sensitive, especially mentioned was the banking sector, given that they have a lot of loans to the commercial buildings as well as to the retail. And that will have an impact in the longer run.
Many thanks for your insights this morning. Kian Soon there, CEO and Fund Manager, Astral Asset Management. Walt Disney's Lucasfilm is winding